We are going over the latest portfolio results. We had some rapid and sharp drawdowns yesterday, the last 2 days. All 77, all strategy access portfolio in a $22,000 out of $34,000 drawdown. How often does this happen? Is this a regular, normal thing? And you can look at the drawdown curve and see that it is. And you see, let me pull the pen out. Here is the current drawdown. You see this happens here. Drawdowns like this happen here. Quite frequent sharp drawdowns like this happen on a very regular basis. Even these are very rapid sharp drawdowns. And so what this does is this gives you an opportunity to get in on a portfolio on a drawdown to buffer any initial drawdown in your portfolio or worst case drawdowns, or if you're trading it already and you have the capital, you can add contracts on drawdowns to reduce your risk to worst case drawdown or to buffer a worst case drawdown, which can happen in higher volatility or new market scenarios. And so we can take a look at this in the other portfolios as well. I want to show you it's important to understand the drawdown curve. And so I always encourage clients, if you're waiting to start, if you want to keep your risk tolerance low, then start on a drawdown. And so this sharp drawdown gives you that opportunity to get in on this type of portfolio. All 77 strategies, very actively traded multi-system portfolio. And so these drawdowns, these sharp drawdowns will occur. Stock index portfolio 2020, we had an equity peak on Wednesday and then a $14,000 drawdown since then. And let's go back to the all 77, show you where we are. And so yeah, this drawdown, this has been chugging along, kind of going sideways, moving towards an equity peak on Wednesday, and then you get this sharp drawdown. It's down 9,900 on the month, and so it's been doing well this year. And we have 1 week left, and oftentimes that last week or the last few days of the week or the beginning of the month, end of the month, beginning of the month can sometimes be better. And so I'm looking forward to this last week of trading. It's going to be a very active week with the news cycle. And so down 9,900 on the month in this portfolio, and you're at a good drawdown entry point to step in here if you have not already. If you're sitting on the sidelines, want to actively trade. Stock index portfolio 2020, $14,000 drawdown. It is down 1537.50 on the month. After having a big June, it was up. We were up on the month, and then we had this rapid drawdown. Tick count trend 2 was one of the more challenging strategies, and we're trading 2 contracts of that in this portfolio. So thinking about reducing this to 1 or 0 because I don't like the way that's trading with the current market divergences. Something that we'll take a look at on an end of month basis. Stock index portfolio 36. This strategy has a lot more this portfolio has a lot more strategies, 36 strategies, and so it's only in a $15,000 out of $43,000 drawdown. There's more diversity. It's a little bit looser fit portfolio. It's done well this year. It's down 6,700 this month, and it's also in a drawdown. So as I move down the screen, these charts update when I get there, and so you see the depth and length of some of these drawdowns. Now this one can have the length of this drawdown is fairly significant in one of the longer drawdowns we've seen in the past. But here is where this drawdown is. It's very very normal to be in this drawdown for this portfolio in this area. It comes to that point quite a bit, and as volatility increases, it will come to that point more. You see it coming to this point and bouncing a lot more than in, say, this time period. This time period didn't even come to this point, and then in the recent year, in 2020, it's come to this point and bounced a lot. And so let's look at the length of this drawdown here. So if you're trading the 36 system portfolio, the last equity peak is right in here. And so that is around 2016, almost a full year where you're sideways on this as far as new equity peaks. Now the drawdown happens here, and then you start having profitable months here as you come back, but you're not at new equity peaks from this point until this point. And so that is something you take a look at. Let's look at 2016 when this happened. So 2016, huge January, and then you went through, a year that had, you're doing this a lot of 4, 5, 6, 7 losing months in a row in 2016. And so really strong start. You're up 29,000, down 1,900, up 23,000, And then 1, 2, 3, 4, 5, 6, 7 losing months in a row. And then you end the year plus 30. 24.6 and 6,700. This is normal in trading. So you're trading a lot of strategies in ES and NQ, so you don't have a lot of market diversity, but you have methodology diversity. And so it's normal for a large percentage of the gains to come in a short period of time. You have to be willing to go through long periods of time where it feels frustrating and stick with it. And so that's in the data, and we've seen that in the past in some of these portfolios. Now let's take a look at stock index portfolio, the 200K. 200K is very similar to the stock index portfolio 19. It is a stock index portfolio 19, and then it adds some commodity markets that you see there. And so going in here, big month in June, $40, break even in July. It's in a 14 out of $26,000 drawdown. Once again, thinking about adjusting this tick count trend too. Do not like the way that strategy is trading. And so big year though, 142. And then you see the drawdown curve. We had an increase in volatility, and the worst case drawdown was here on the 200K, and then it made a worst case drawdown, and it bounced. And so you have to be willing to, this is one of the reasons why I say wait for a drawdown, and then your risk to worst case drawdown is less, and you can buffer a new worst case drawdown when that happens. And so there was a worst case drawdown and during the pandemic. So spike in volatility, and you see a widening of your risk increase, and volatility increases, price values increase. That's just normal. As markets go up, you also see profitability go up. So let's look at the profitability of the first 7 months in July is 142. What was the profitability in 2019? The first 7 months was 58. The first 7 months of 2018, 133. 2018 was pretty volatile. First 7 months of 2017, low volatility year, is plus 91. First 7 months of 2016 is plus 75, about half as much. 44 in 2015, 93K in 2014. In 2013, it is 27K. 2012, it is 65K. So the biggest first 7 months so far also includes a larger drawdown because volatility has picked up, and so margins have picked up, so it requires more capital as well at times. And so let's look at the 25K portfolio. It's in a $2,000 drawdown. It made equity peaks 2 days ago. This is only 10 strategies. It's a diverse group of markets. It doesn't trade as frequently. It's up 59, 22, 50 this month, and up 41K on the year. Already at the same, if you take a look at 2020, the first half is roughly, well, we got 7 months in. Let's look at the first half. It's up 35K. In 2018, similar volatility, was up 46K. The second half of 2018 was up 39K. And we'll see what the second half of 2020 brings if you can project volatility. The second half of 2019 was only 14K. So still, that's not a bad year. The first half of 2017 in this portfolio was up 24K. The second half was 17K. And so you see most of these years, this is met or exceeded most of the years in the past, but we have higher volatility now. So I would anticipate higher volatility, potentially a worst case drawdown. We've held in pretty good this year, and so this portfolio is really stable on the drawdown with the increased volatility, and has also benefited from the extra profit from the volatility perspective. It trades a lot less trading systems, so it's a lot more conservative. The micro stock index and gold portfolio, it's gotten hit pretty hard the last 2 days as well. Now, we call it the micro stock index and gold portfolio because micro ES, micro NQ, and micro gold are the three markets that this trades, the most liquid micro portfolios. This can be traded on the minis. We actually take the mini data from TradeStation and divide by 10 to get these results, and it's in a $2,200 out of $3,721 drawdown, so $1,500 to worst case drawdown. How how frequently does that happen? Let's look at the results of the update. And so you see it happens a lot. You see these drawdowns that happen a lot. They're sharp drawdowns, they're fast drawdowns, and past performance is not an indicator of future results, but it's always it's in the past it's been a good place to get in. It can go further though, so you have to consider that. And you can, if you're not in or you want to add contracts, now could be a good time to add contracts to this because your risk to worst case drawdown is lower. But be careful stopping on a worst case drawdown. You want to be able to endure a worst case drawdown as well, and so that's why I say wait for a worst case drawdown. So that's the micro stock index and gold portfolio. It is down on the month. It's had a strong first 6 months, up 20K. So I mean, if you're just trading this portfolio setup and you have 35K in your account, and you're trading the micros, then you would be up 19K roughly, and then that's through July. That includes July's results. And so, what if you project that out to July through December? We still have another 6 months to go, and if you want to project something out and you're down on the month, and that's good, because if you made 20K in the first half and you say, well, let's project 20K. Now this is just a hypothetical discussion. If you're projecting 20K in the second half, you haven't made it all yet in July. It's not like you're up 3 or 4K in July. You still have time to get in, even though you only have about 5 months left in the year. And so I do anticipate higher volatility as we go into the end of the year, the news cycle, the elections, and we've really gone through a slow period here in July, weird VIX and weird divergences. And so return to normal, I anticipate that this is what's possible. If you trade the second half of, if you just trade in the second half of the last 5 months of 2019, you get 59.40. That's still not bad. 59.40 during a low volatility year. In 2017, you're up 3,000. So it's low, but it's the potential for profit is there if low volatility does occur. 2016, 38.78. This wasn't the election year. So 2016 election year, the last 5 months, 38.78. 2012 election year, the last 5 months is 55.64. So I mean, you could trade a multiple of these as well. If you're trading the minis instead, that's 55,000. If you're trading the micro, it's 55.64. If you're trading 2 or 3 of those, you can multiply those numbers as well. Let's look at the next setup. 100K day trade, 2020. And so sharp drawdown, good place to enter. Good place to enter. Up on the month, about 340, just barely up. I call that break even. I don't really consider plus 340 up on the month. I consider that a break even. And so it had a nice June, a really strong January, February, March. April down. April through June is up only 3,800, and then break even in July. And moving into the last 5 months of the year, we have 1 week and 5 months of trading left in the year. This is the 100K day trade portfolio. Here's where it is on the drawdown curve. Good entry point. Real good entry point on that. So let's look at the next portfolio setup. Liquid day trade portfolio. It's in a 14 out of 25K roughly drawdown. Minus 42.50 on the month. And here is the drawdown curve. So good entry point, fairly wide. This portfolio has some wider drawdowns. It's less diverse. And so you see the width of the drawdown and the width of the drawdown is similar to the length of the drawdown from equity peak to equity peak. So it takes a little longer to recover when you trade this portfolio, and it has held up well this year compared to the past. It's in relation to worst case drawdowns though. So let's look at SR counter trend portfolio. SR counter trends, 18 out of 28K. We had a nice, let's go to the calcs page. We had a nice, we called in and said, hey, this is a good place to get in after this loss if you're waiting for a drawdown. And it had this run up, and then got hit on Thursday with some SR counter trend losses in the stock indexes, ES, and also in silver. So let's see, since this time period, it is still up 7,800 and still a good entry point, 18 out of 28K. Let's look at the monthly results. This is the same methodology over a broad range of markets. Slight variations in different SR counter trends, but you don't have a lot of methodology diversity in this approach. You have what I would call a diverse group of markets using the same market methodology in general, the same concepts. And here it is in relation to worst case drawdown. Less diversity in either methodology or markets usually lends itself to longer drawdowns. And so we're getting a kind of a wide drawdown, but it's within worst case drawdown levels. So we're right here. These are a little bit higher than this level, but it's above this level right here. So good entry point if you want to buy into a drawdown. It's actually, the drawdown is actually right in here in the 18K area. It had made a 23K drawdown. It's now at 18K. And so that's the SR counter trend portfolio. And these strategies are part of the All Strategy Access portfolio. So this methodology is incorporated into what you're already doing. And that is the portfolio wrap up for sharp drawdowns in the portfolios, and the list of all the portfolios and the results on the month with 1 week and 5 months left to go in the month. And just a brief summary as we take a look at that, we have to see where we are. You know, it can be frustrating and discouraging to go through drawdowns, but you have to keep it in perspective. You have to look at what it's done in the past, and there's no guarantee that, you know, something drastically wouldn't change and it wouldn't go through another worst case drawdown before it rebounds. But this is how we analyze the portfolios and the perspective that we like to keep when we're trading a group of trading systems.